Happy to have you back for the next chapter in your financial growth. In the last segment, I discussed the mutual insurance company and gave a brief overview of how family banking works. Now let's take a closer look at policy design, the benefit of family banking, and your human life value. Okay, I want you to do something for me. Imagine this scenario. Let's say you own a business and have a personal attorney. Your attorney advises you that based on your net worth, you need $1 million worth of whole life insurance. In this scenario, who determines your minimum premium, or also known as the amount you pay per month for insurance? If you guessed the insurance company, you're correct. So in the same scenario, who determines your maximum premium? That's basically how much you can overpay for insurance. This one's a little bit trickier. First, let's define what is meant by maximum premium. If a minimum premium is the least amount necessary to keep a policy active, then a maximum premium will be the highest amount you're allowed to pay above and beyond that minimum. But why overpay? Paying extra can increase your policy's cash value faster than paying the base premium alone. Furthermore, when paid into a properly structured whole life policy, the benefits of overpaying get even better. Remember that sailboat mast and sails from the last segment? Those riders are overfunding mechanisms that effectively lower your policy's base premium, so each payment you make increases the amount of cash value even faster. So who determines the maximum premiums? Believe it or not, the IRS. Now, you may be thinking, but the IRS doesn't get involved in auto insurance or homeowners insurance, so why would the IRS regulate life insurance? Here's the thing. I know how most people feel, but the IRS has no evil intentions. It plays an important role in maintaining the stability of our economy, right? Remember how Congress pays for all the government programs? Taxes. So if there's a surplus of non-taxable cash in America, you better believe the IRS will be very interested in limiting that amount for the benefit of the economy, of course. Now let's continue. In addition to setting maximum premiums, Section 7702 of the tax code also places limits on the amount of coverage a person can have based on their age, sex, and annual income. This is a major drawback of the design because while you may want to contribute as much money as possible to the policies, the tax code imposes limits based on your human life value, as determined by the IRS. Now let's go back to the personal attorney scenario. Say you're a 39-year-old male and make $55,000 per year. Based on the chart, your human life multiplier will be 30. That means you multiply your annual income by 30 and find that your human life value is $1.65 million. What does that mean? It means that the most life insurance coverage you're allowed to have is $1.65 million. Now that may sound like a lot of money, but underwriting amounts can cut into that amount significantly. So what is the main benefit of having a properly structured policy? If the minimum premium for this coverage is $215 per month and the maximum premium is $1,000 per month, there's a difference of $785 per month. Where does that $785 go? While a small amount assists in growing the death benefit, most of it goes directly towards your cash value growth. It's like a supercharged savings account. A family banking account also provides you with these benefits: guaranteed growth, a tax-free death benefit, tax-free accumulation, tax-free distributions, dividends. It is available prior to age 59 and a half without penalty, privacy and control, protection, and zero volatility. As you can see, a properly structured whole life policy can provide a secure, steadily growing pool of funds. Next up, we'll explore the 3 types of spenders and which type you should aspire to be. See you there.